Greetings, everyone. Today, we're going to dive into the ExxonMobil Pension Plan, one of the most significant retirement benefits available to employees. My name is Kyle McClain, and I'm a partner and senior wealth manager with Rame & Gurrell Wealth Management. The ExxonMobil Pension Plan plays a crucial role in retirement planning for many employees. However, making the most out of this benefit requires an understanding of how it works, the options available, and how to optimize the value of this important asset. Today, we'll answer questions involving what the ExxonMobil Pension Plan is, your pension distribution options, how interest rates impact your lump sum, the importance of 55 and 15, and much more. Whether you're nearing retirement or just starting to think about it, this video will help you better understand how the pension is calculated, how distributions are handled, and the tax implications involved. As always, if you or someone you know could benefit from this information or the other services that our firm offers, we invite you to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an employer benefits, executive compensation, investment, tax, estate planning, and retirement planning perspective. The ExxonMobil Pension Plan is a defined benefit plan, which means that the benefit amount is predetermined based on your years of service and your highest average compensation at the company. This calculation plays a crucial role in determining the ultimate value of your pension. The formula for calculating your pension benefit is based on several key factors: the pension multiplier, your years of service, and your final average pensionable pay, as well as a Social Security offset. Here's how it breaks down. The pension multiplier is a fixed percentage used to determine your benefit, set at 1.6%. This multiplier plays a pivotal role as it represents the portion of your average pay you'll receive for each year of service. Your years of service are then multiplied by the pension multiplier. The more years you have with ExxonMobil, the greater your benefit, as each additional year increases the total value of your pension. The cornerstone of the pension calculation is the final average pensionable pay, which is the average of your highest 36 months of compensation during your final 10 years of service with the company. For 2026, the maximum amount eligible to be considered for pensionable pay is capped at $290,000 according to IRS guidelines. Any income exceeding this limit is factored into the Supplemental Pension Plan, or SPP, which operates on a similar calculation. So, the initial formula for calculating your pension benefit is 1.6% multiplied by your years of service, multiplied by that final average pensionable pay. However, there is one additional component that must be accounted for: the Social Security offset. The Social Security offset is a reduction applied to your pension benefit. Since ExxonMobil pays 50% of your Social Security taxes, they account for this by offsetting your pension. The offset is calculated as 1.5% of your estimated Social Security benefit for each year of service, up to a maximum of 50%. This means that if you have 10 years of service, your pension is reduced by 15% of your projected Social Security benefit. The cap at 50% ensures that your pension will not be reduced beyond half of your Social Security amount. Once you reach retirement, you'll have several options for receiving your pension benefit. The pension can be paid as an annuity, as a lump sum, or a combination of both. The most common options include the 100% lump sum. This allows you to take the entire value of your pension as a one-time payment, which can then be rolled over tax-free into an IRA. This allows for greater flexibility in how the funds are invested, and taxes continue to be deferred until those funds are distributed from the IRA. Next, we have the qualified joint and survivor annuity. This option provides monthly payments for the rest of your life and continues those payments to your spouse after your passing. There are also 5, 10, 15, and 20-year certain annuities. This option guarantees that payments go for a set number of years, and this makes sure that your beneficiary continues to receive payments if you pass away before the selected time period is up. Additionally, there are joint annuity options that provide continued benefits to a beneficiary after the retiree's death. Now, if you're considering a lump sum distribution, it's essential to understand how segment rates impact the present value of your pension. As interest rates rise, the value of lump sum distributions will decrease. When interest rates retreat, lump sum values go back up. This is what we like to call the pension seesaw. Higher interest rates reduce lump sum payouts, while lower interest rates increase them. The rates applicable for the lump sum calculation, these segment rates, are published by the IRS and calculated quarterly, so the timing of your decision to take a lump sum can have a significant impact on the value that you receive. If you work at ExxonMobil, you've also probably heard the phrase 55 and 15. This rule refers to the eligibility for full retirement benefits once you've reached 55 years of age and have completed 15 years of service with the company. Once you've hit these milestones, you become eligible for the full range of retirement benefit options, including the pension. If you retire before reaching age 60, your benefit will be adjusted downward by 5% per year. However, if you leave the company before achieving retiree status, your pension benefit is subject to a much larger reduction. Understanding the timing of your retirement is key to maximizing your pension benefit. The ExxonMobil Pension Plan is one of the most valuable retirement assets available to employees. However, making the most of this benefit requires careful planning around when to take your pension, how to choose the right distribution option, and understanding the tax implications of these decisions. At Raymond Gorell Wealth Management, we have over $1 billion in assets under management. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specializes in helping our clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life, both before and after retirement. Again, we invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.